from Jason. What's your advice on getting out of current investments to move to Rule 1 investing? Where do I start? Okay, evaluate, look and see if you're substantially over the value of that business. And then, as we just heard, you could put in stop losses or you can exit. If you put in stop losses, you're going to have to kind of follow them up, right? Or they're not much point to it. You might as well just get out. But that's what I would do. Leave in place the companies that you own that are on sale, and exit or get ready to exit the rest of them. That's what I would do. Now remember, I'm not advising you as your advisor. I'm just giving you an education. That's where Buffett's at. He's not buying anything. That's where we're at. We're not finding anything we can buy right now. So get ready for a downturn. Can you build generational wealth without doing options? 100%. Warren Buffett is one of the better options traders in the world, maybe one of the biggest. And it does increase the velocity of your returns. But remember what I showed you guys about that group of investors in Singapore, the paper portfolio that some of them invested in almost certainly has done, 20, 21% per year, compounded for 15 years and turned 100,000 into almost 1.8 million without a single options trade, without a trade of any sort. So absolutely. Generational wealth is not based on options trading per se. It's based on owning really good businesses. Because here's the thing. Ideally, you want a passive portfolio. You want to give your kids a passive portfolio. Just let them own some great companies and ride it out. That's the best. And then if you want to be more involved, do options. With the Wilshire GDP ratio on uncharted territory, how do you look at risk reward? I just look at that thing as another indicator, another red flag, right? Schiller's way up there. Wilshire GDP's way up there. The S&P 500 is at 24 right now with a history of 16, 50% above where it traditionally is. Everything is pointing to a massively overvalued market. We printed off a crap load of inflationary dollars. The shadow inflation, in other words, if you calculated inflation at the rate, the way they did in 1980 when Reagan was president, if you calculate, or when Carter was president, we had, inflation running really high and they raised bonds up to 19%. If you calculated it like that, right now we'd be running 8%, not 3.5%. So yeah. How do we look at risk reward? We simply say, what do I have that's overpriced that I can sell off to get into cash to be ready to take advantage of the next crash?